I'm going to buy silver. It's $100, $120, $200, $250, $600. Oh, I better buy it. But actually what's been happening is that the silver price has been managed by China. You've got this deficit, which quite correctly comes out of the Silver Institute's tables. That has been made up by China exporting silver. You could put it that China foresees a situation that's not prices rising, but the currency's falling, and she's indulging, if you like, in a central bank's version of a crack-up boom. This is something that the economist Ludwig von Mises wrote about People's Bank, the SGE, have done. But bear in mind, the SGE is owned and run by the People's Banks. They weren't going to survive. So what she had to do was to play the fiat currency game, but never forget she needed to protect herself against their collapse. She's probably, as the state accumulated a further 20, maybe 25,000 tons into the hands of the public, that is a further 28,000 tons.
We seem to be stuck at around the $60 range since a fairly sharp drop in price from around 70 at the end of last month. Are you viewing this as a buying opportunity, a time to exercise caution? And what is your outlook for the silver market for the rest of 2026?
Well, silver is very volatile, and the only way to treat it is stack, 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 in my view. The price doesn't really matter in the sense that what I'm doing when I buy silver is I'm just getting rid of fiat currencies. That's the main thing. I'm trying to sort of guess where it's going, and using charts and all this sort of stuff is not really the point. I'm pretty certain that once silver moves, and I don't know when that'll be. I mean, I've got opinions, but I can't do more than that. When it really moves, I know one thing for absolute certain: all those people who've been going on about, I'm going to buy silver, when I think it's right, well, they'll miss it, and then they'll be trying to catch their tails. You'll find it's $100, $120, $150. Oh, it's got to come back. I mean, it's going up too fast. It's got to come back, and then I'll buy it. $200, $250, $600. Oh, I better buy it. 10 times above where it is now. I mean, that's what happens. This is my experience of traders.
Markets may appear calm, but history shows that hesitation has often cost precious metals investors more than short-term volatility. As Alasdair Macleod explains, waiting for the perfect entry point can become a psychological trap, especially once market momentum begins to accelerate. The greater risk is not temporary price fluctuations, but the steady erosion of purchasing power caused by weakening fiat currencies. A disciplined, patient accumulation strategy tends to reward long-term investors far more than emotionally driven trading decisions. Next, Alasdair Macleod explains why the most significant silver rallies often begin only after the majority of investors convince themselves to keep waiting.
Some traders get it right, okay, which is good, but they are a minority, and all this fooling around, trying to double guess markets and all the rest of it, it misses the point. What we're actually seeing is the death of fiat currencies. And in that case, I mean, you may as well go and buy copper, you could buy gold, you could buy oil, you could buy, anything that you can take delivery of, you should buy just to get the hell out of fiat currencies, because they're going to zero. But there will always be a need for silver, gold, copper, oil, whatever. So that's what you should own.
The Silver Institute projects the market will remain in structural deficit for a sixth straight year here in 2026, with mined silver production expected to rise only modestly, around 1%, according to some forecasts. Surely we're reaching the point where the physical supply-demand imbalance has to trump paper speculation. Would you agree with that?
Yeah, I think you've got to, people have got to understand actually what's been happening with silver. The Silver Institute is right. I mean, you can draw up supply, demand, surplus deficit type charts as much as you like. But actually what's been happening is that the silver price has been managed by China. China is it's the largest importer of the sources of silver, which are non-ferrous ores, particularly copper, zinc, to a lesser extent lead, and also gold. That's where it all comes from. I mean, over 70% of silver comes from that.
A sixth consecutive structural silver deficit should be making headlines, yet institutional attention remains remarkably subdued. According to Alasdair Macleod, traditional supply and demand charts fail to capture a much larger force at work when state actors influence physical metal flows behind the scenes. Investors who focus solely on paper prices may be overlooking where strategic inventories are actually moving. Physical ownership becomes increasingly important when official narratives diverge from underlying patterns of accumulation. Next, Alasdair Macleod explains why China's silver strategy presents a contradiction that conventional paper markets struggle to explain.
And as a result, basically, China has been accumulating huge amounts of silver for a very, very long time. It's part of official policy, not publicly declared. They don't go out and tell us this month we bought this month we refined so much, and that produced so many tons of silver. No, of course they don't. They don't tell us what's going on. But believe you me, the policy going back to 1983 has been to accumulate gold and silver. And the PBOC has total responsibility for the acquisition of gold and silver. Now, what's happened is that in the last however many years, when you've got this deficit, which quite correctly comes out of the Silver Institute's tables, that has been made up by China exporting silver to satisfy demand. Why? She's been keeping the price of silver under $50. So, and then this changed. This changed sometime, I would guess, in sort of late September, early October, probably late September, along with rare earths. I mean, the rare earth story had been brewing up for a little while. But quite clearly, China was not going to export silver for America, which had then decided it was a critical mineral, to supply America. So what did she do? She reversed her policy. And we saw silver jump from $50 in I think it was sort of early October, all the way up to 120. And if you look at what China has done in the first quarter of this year, she has bought a total, I think the figure is 1,626 tons.
China's actions began shifting long before most investors noticed the surge in prices. What Alasdair Macleod highlights is that decades of strategic accumulation carry far greater significance than short-term market sentiment. If exports have genuinely slowed while domestic purchasing has accelerated, the official supply narrative becomes far less convincing. Rather than focusing solely on headline explanations for market volatility, investors should pay close attention to government actions and long-term strategic behavior. Next, Alasdair Macleod explains why China's import data appears to contradict the prevailing market pricing narrative.
Now, we haven't been given any export figures because usually there's imports and exports. But for some reason, there hasn't been any export figures, if you like, issued. Now, this 1,626 tons annualized, we're looking at about 5,000 plus tons. Now, this, if you like, compares with the roughly 3,000 to 5,000 tons which China has been exporting every year recently to satisfy and to deal with that supply deficit in the West. So, in other words, this is a completely volte-face. And it's fascinating that she has acquired all this silver at a time when we've been trying to get the hell out of it. I mean, this is part of a wider policy, actually, because at the same time, China has imported 163 tons of non-monetary gold. That was up to May. We haven't had June's figures yet. And on top of that, there's a further 40 tons recorded of non-monetary gold. So that's an addition to the 163. So around about 200 tons gold. And that's what's been reported. I mean, it could be, the truth very often in these things is somewhat different. So what's she doing? What's she doing with stockpiling copper? What's she doing sort of ceasing exports of things like fertilizers and sulfuric acid and so on. I mean, the answer to this, quite simply, is she doesn't want any dollars. Her trade surplus is now hitting records. So she's earning foreign currencies, which she knows are going to go to zero. She doesn't want them.
When a major trading nation begins favoring hard assets over accumulating surplus dollars, investors should take notice. Alasdair Macleod argues that China's aggressive commodity stockpiling reflects a long-term strategy for managing currency risk rather than routine trade policy. Whether every reported figure is entirely accurate or not, the broader direction of the policy warrants careful attention. Investors and savers who rely exclusively on financial assets may be underestimating the risks associated with a changing monetary landscape. Next, Alasdair Macleod explains how China's commodity acquisitions could signal a broader shift away from holding fiat currency reserves.
So, if you like, you could put it that China foresees a situation that's not prices rising, but the currency's falling. And she's indulging, if you like, in a central bank's version of a crack-up boom, which for people who don't understand what it is, I mean, this was something that the economist Ludwig von Mises wrote about because he experienced the demise of the Austrian shilling and also observed the demise of it was the Austrian crown in those days. He also evidenced the hyperinflation in Germany, which lagged the Austrian one just slightly. And he observed that in around about the last 5 or 6 months of this, this collapse of the currency, people suddenly realized that it wasn't prices rising, but the currency going down. Now, the moment they realized that, they dumped the currency for anything, just to get rid of it. They bought anything, even if they didn't need it. They just wanted to get rid of wheelbarrow loads of this rubbish. And that's precisely what China is doing.
But I believe China is the #1 gold producer and the #2 silver producer in the world. So while a lot of people are paying attention to the import-exports, is China officially reporting all of the silver and gold that they're mining? And how much of that do you think they're taking into their own reserves as opposed to exporting to other countries?
Well, I mean, the answer, I've always maintained that with respect to gold, China is like Hotel California. You know, you're welcome to come in, gold ingots, but you ain't leaving, if you see what I mean.
Periods of monetary instability have historically unfolded in sudden shifts rather than gradual declines. This is where Alasdair Macleod's thesis moves beyond commodity prices and focuses on the erosion of purchasing power as the central issue. Whether his historical comparisons ultimately prove correct or not, the growing trend of governments accumulating tangible assets warrants close attention. For investors, the priority should be preserving long-term purchasing power rather than focusing solely on nominal returns. Next, Alasdair Macleod explains why China's domestic gold policy may have a greater impact on the future of the gold market than global mine production itself.
So on that basis, it's really, anything that she's mined, she has kept. So you can add that, if you like, to the balance of, exports, imports. I mean, there have never been any exports. But interestingly, in the last week or two, it's become evident that that is changing. What happened is that the People's Bank of China issued a note saying you no longer need to ask our permission, the central bank's permission to export gold. It's just a customs matter. What that means is that people owning gold in China can send it from China to Hong Kong as part of this new market. I suppose they can send it anywhere, but it's still got to go through customs. So I guess that they'll probably restrict it to this new Hong Kong, if you like, market development. So you've now got freedom of movement in gold between the Shanghai Gold Exchange and the new Hong Kong market. So that is a big, big change, and that's happened literally in the last 10 days or so.
Yeah, I want to touch on that because Hong Kong has launched a new gold clearing and settlement system. At least six major banks signing on, including JP Morgan, Deutsche Bank, and many others. Hong Kong's chief executive, John Lee Ka-chiu, stated the launch of Hong Kong's central clearing system for gold will create a historic foundation, allowing us to take the next major step, and that's building a comprehensive gold trading ecosystem.
Major market shifts often begin with infrastructure developments that attract little mainstream attention. Alasdair Macleod notes that increased gold flows between mainland China and Hong Kong could gradually reshape regional liquidity dynamics. Clearing and settlement systems rarely make headlines, yet they play a critical role in determining where capital ultimately accumulates. Investors focused solely on daily price movements may miss the broader significance of these evolving financial structures. Next, Alasdair Macleod explains why Hong Kong's emerging gold ecosystem has the potential to challenge the traditional Western-dominated trading framework.
If gold is the world's safe haven, Hong Kong will be its safe harbor. Very interesting development. What do you think it means for the global gold market as well as the gold market within China? You've alluded to it, but would love to get some more thoughts from you.
Yeah, it's quite simple. You've got to look at this in connection with earlier moves that the People's Bank and the SGE have done. Bear in mind, the SGE is owned and run by the People's Bank. So, when we talk about the People's Bank and the SGE, we're really talking about one organization. What they did was they opened a vault in Hong Kong, which was an exchange facility, if you like, for gold for Chinese yuan or Chinese yuan for gold for anyone. And it all fits in with the new payment system, the SIPS payment system, which they've put together. And they've also, interestingly, been opening another vault in Saudi Arabia. And there's talk about these vaults being new vaults being opened in Southeast Asia. There was stories that they would probably open one in Dubai, though events have rather overtaken that. And there was even mention, and I think it was probably a bit speculative, that they would open one in Zurich. I mean, the point is that right from the outset, China realized that fiat currencies never, ever survive. She was emerging from the Mao era into a world of fiat currencies.
Infrastructure often reveals strategic intentions long before they appear in policy speeches. According to Alasdair Macleod, the expansion of vault networks and settlement systems suggests preparation for larger bullion flows outside traditional Western channels. Whether these initiatives ultimately reshape global pricing mechanisms remains uncertain, but they point to deliberate long-term planning rather than short-term speculation. Investors should take notice when institutions invest in critical infrastructure before demand has fully emerged. Next, Alasdair Macleod explains why these vault expansions could prove far more significant than yet another central bank press conference.
They weren't going to survive. So what she had to do was to play the fiat currency game, but never forget she needed to protect herself against their collapse. And this has been her policy the whole way through. She, between 1983, when the People's Bank was appointed with responsibility for the entire nation's gold and silver reserves, I mean, I'm not talking about bank reserves, but ownership of gold wherever. 1983, she started accumulating gold in that big bear market. I reckoned, and I did some calculations, it was very much a back of the envelope type calculations, but I reckoned that at contemporary prices, she probably accumulated around about 20,000 tons by 2002. The reason 2002 matters is that the Shanghai Gold Exchange opened, and for the first time, citizens in China were allowed to own gold. And indeed, I think 4 or 5 years later, the Chinese government even advertised, they did television adverts, buy gold, it's good for you, whatever the strapline was. So you can see that there's been a deliberate policy here. They've also as you alluded earlier, they accelerated mine production very, very significantly to the point where they rapidly overtook South Africa, which admittedly was declining in its output, and has been the world's largest gold output, miner, if you like, by output for, I can't remember when the crossover was, something like 2007, 2008. So that's been, almost 20 years she's been the largest mining nation.
Long-term strategy is often overlooked because financial markets tend to reward short-term, quarterly thinking. What Alasdair Macleod is highlighting is not a reaction to recent economic uncertainty, but rather a policy framework that has been developing over many years, if not decades. While individual estimates may be subject to debate, the sustained investment in production capacity and market infrastructure points to deliberate, long-term planning. Investors should focus on distinguishing temporary headlines from deeper structural trends. Next, Alasdair Macleod explores where decades of physical gold may have quietly accumulated beyond the public spotlight.
And then we have seen this continual migration of physical gold from Western capital markets into China, never to return. So my guess is that she's probably, as the state accumulated a further 20, maybe 25,000 tons. And of course, you've also got the deliveries out of the Shanghai Gold Exchange, most of which has gone into jewelry, admittedly, into the hands of the public. That is a further 28,000 tons. We don't have scrappage figures, but anything that's scrapped has gone back into the SGE. Into the SGE vaulting system, and would have, it hasn't left the country.
The steady movement of physical precious metals toward the east, while financial markets remain largely focused on paper assets, highlights a divergence that many investors overlook. Alasdair Macleod argues that cumulative bullion flows may be far more significant than short-term price fluctuations. While precise estimates of national gold reserves remain uncertain, the continued accumulation of physical bullion raises important questions about the future of monetary confidence in the global financial system. For long-term investors, monitoring where physical ownership is becoming concentrated may provide valuable insight into emerging shifts in economic power.